Walk down any suburban street in America right now. It looks peaceful. The lawns are manicured, the cars are in the driveways, and the windows are clean. But if you look closer, you'll notice something missing. For sale signs, they are gone. In neighborhoods where you used to see a constant rotation of moving trucks and open houses, there's nothing, just silence. We are told this is a supply shortage. We are told that we simply haven't built enough homes to house a growing population. And while that is technically true, it is a convenient lie that masks a much darker reality. There isn't just a shortage of wood and concrete. There is a glitch in the financial architecture of the housing market. It is a mathematical anomaly that has frozen the entire system in time, creating a strange paradox where the economy is moving forward, but the American dream is trapped in the past. And the most disturbing part? The people running the economy know about it, the banks know about it, the government knows about it, but no one is trying to fix it, because fixing it would mean destroying the wealth of the most powerful voting bloc in the country. To understand this glitch, you have to go back to the fever dream of 2020 and 2021. During those years, the Federal Reserve flooded the system with cheap money. Mortgage rates hit historic lows, 2.5%, 3%. It was practically free money. Millions of Americans did exactly what any rational actor would do. They refinanced. They locked in those rates for 30 years. At the time, it felt like a gift. But today, it looks a lot more like a trap. Economists call this the lock-in effect, but that term is too clinical. It doesn't capture the reality. Let's call it what it really is: golden handcuffs. Here is the math that is quietly destroying the market. Let's say you bought a home 3 years ago with a 3% mortgage. Your monthly payment is $2,000. Today, if you wanted to move to a slightly better house down the street, or even a similar house in a different city, you would be trading that 3% rate for a 7% rate. That doesn't sound like a catastrophe until you run the numbers. That jump in interest rates means the same monthly payment now buys you half the house. Or, if you want the same quality of house, your payment doubles. You aren't moving. You can't move. Even if you get a new job, have another kid, or get divorced, the financial penalty for selling your home is so severe that it makes more sense to stay miserable than to sell. This has effectively removed millions of homes from the market. They exist physically, but economically, they have vanished. They are vaulted away, effectively taken out of circulation for the next decade. This creates the glitch. In a normal market, when prices get too high, demand drops, inventory sites, and prices eventually come down to meet the buyers. That is Economics 101. But we broke Economics 101. Because nobody is selling, inventory remains at historic lows. Because inventory is low, prices stay high, even though interest rates have skyrocketed. We have created a Frankenstein market, the unaffordability of a high-rate environment combined with the scarce inventory of a low-rate environment. It is the worst of both worlds for a buyer, and for the seller, it is a gilded cage. Now you might ask, why doesn't the government step in? Why doesn't the Federal Reserve lower rates to unfreeze the market? Or why don't they incentivize building to flood the zone with new supply? This is where the skepticism needs to kick in. You have to look at who benefits from the glitch. The reality is that a frozen market is preferable to a crashing one. The United States economy is addicted to high home values. For the average American, the home is not just a shelter. It is the retirement plan, the emergency fund, and the primary source of wealth. If home values were to drop by 20 or 30%, which is what it would take to make housing affordable again for the average worker, it would wipe out trillions of dollars in household wealth overnight. Voters would revolt. Retirements would be delayed. Consumer spending would collapse because people feel poorer when their Zestimate goes down. But it goes deeper than just unhappy voters. The banking system uses real estate as collateral. If the value of that collateral plummets, the balance sheets of regional banks start to look very ugly very quickly. We saw a preview of this instability recently. The system cannot handle a deflationary crash in housing. So the powers that be have made a silent calculation. They have chosen stagnation over correction. They would rather have a market where transaction volume is dead, realtors are starving, and mortgage brokers are out of work, than a market where prices actually reset to reality. This is why you hear so much talk about demand-side solutions. Politicians love to talk about giving first-time home buyers $25,000 in down payment assistance. It sounds nice. It sounds helpful. But if you give everyone free money in a market with restricted supply, you don't make housing cheaper. You just drive the price up by exactly the amount of the free money. It's inflation with a smile. It's not a fix. It's fuel for the fire. They are pretending to solve the problem while actively propping up the very prices they claim are too high. So what happens next? If they won't fix the glitch, how does it end? We are watching the beginning of a structural shift in American society. We are moving from an ownership society to a rentership society. Since existing homeowners won't sell, the only new supply comes from home builders. But home builders aren't charities. They have high costs for land, labor, and materials. They cannot build starter homes anymore because the margins don't work. So they build luxury units, or increasingly, they build entire neighborhoods specifically for investors to rent out. This is the path of least resistance. If the average family cannot afford to buy, they must rent. And capital is more than happy to step in and become the landlord. Large institutional investors get a lot of hate, and rightfully so, but they are just predators smelling blood in the water. They know the glitch is permanent. They know that the lock-in effect has created a permanent scarcity of single-family homes. That makes those homes a perfect asset class. If the people can't own the asset, the corporation will. The divide is sharpening. On one side, you have the landed gentry, the people who bought before 2022. They are safe. They have their 3% rates, their fixed costs, and their growing equity. They are winning the game. On the other side, you have everyone else, the latecomers. They are facing a wall that gets higher every year. They are trying to save a down payment in a currency that is losing value, chasing a home price that is being artificially propped up by a system that refuses to let it fall. It is a caste system, masked as a market. The house on the hill is still there, the lights are on, but the door is locked and the key has been thrown away. And the most terrifying realization isn't that the market is broken, it's that for the people holding the keys, it's working exactly as intended.